Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. This episode marks the 10th and final episode of the first season of Quant Matters, and we will make a brief review of the topics covered so far. We will also upgrade our humble pricing dashboard to include metrics beyond simple returns and add other niceties. Before we start, I want to mention that the channel has a Patreon page. There you can download the finished code for a historical pricing dashboard that now comes with the metrics discussed on the first season, along with an expanding PDF that collects the materials covered on the channel. It's designed as a reference, especially if you prefer reading or want something to revisit later. So let's go over the previous episodes with quick summaries and why they're relevant to quants. We started with alpha, which measures whether your investment outperformed a chosen benchmark. If the S&P 500 returned 10% and your strategy turned 15%, you generated 5% alpha. It forces you to think in relative terms rather than just celebrating raw gains. And while everybody claims to generate alpha, sustained positive alpha is generally rare, even among professional fund managers. Alpha is the North Star of quantitative investing, the fundamental benchmark that separates strategies that actually add value from those that just ride the market, or worse, underperform it. The Markets and Assets episode maps out the full investment universe available to quants. Public markets like equities, bonds, FX, commodities, derivatives, and crypto, which total about 312 trillion, versus private or opaque markets like real estate and venture capital. While the total tradable universe spans nearly 250,000 instruments, only around 40,000 are liquid enough for serious quantitative work. Understanding which markets exist, their size, and how accessible their data is defines the playing fields for any quantitative work. The Betting and Investing episode draws a spectrum between gambling, which is winning quickly from uncertain outcomes with no repeatable edge, and investing, which is growing well predictably by taking measured risk with positive expected returns. Risk is formalized through probability, and the key insight here is that risk, reward, and time horizon all interact. No asset offers low risk, high reward, and a short time horizon simultaneously. Quantitative finance exists precisely to formalize this spectrum, turning vague intuitions about risk and reward into measurable, testable frameworks and strategies. The Portfolio Basics episode walks you through building an actual investment portfolio from scratch using SPY, IEF, and GLD as stand-ins for stocks, bonds, and commodities. It covers allocations, simulating purchases with historical prices, tracking distributions, marking positions to market, and the critical rule of calculating total portfolio return from combined values, not by average individual percentage returns. A portfolio is the core unit of quantitative analysis, the structured record that makes performance measurable, comparable, and improvable. Risk dives into the specific types of risk lurking behind every investment. Risk of ruin, an asset going to zero, volatility, how far returns deviate from expectations, downside volatility, focuses only on the bad deviations, and drawdown, the peak-to-trough decline of capital. A particularly sobering insight is that the asymmetry of recovery, a 50% drawdown requires a 100% gain just to break even. Quantifying risk is what separates disciplined investing from gambling, because you can't manage what you can't measure. The Historical Prices episode establishes price data as the bedrock of all quantitative work, covering the different price types: open, high, low, close, adjusted close, where to source them, from free tools like Google Sheets or Yahoo Finance up to institutional datasets costing hundreds of thousands of dollars per year, and how to build a small but functional pricing dashboard for the S&P 500 components, mainly using Python, PostgreSQL, and Flask. Historical prices are the raw material of quantitative finance. Without clean, reliable price data, no strategy, backtest, or risk model can be built. The Arbitrage episode focused on the practice of exploiting price discrepancies for the same asset across different markets. So you could buy cheap on exchange A and sell higher on exchange B, and you could pocket the spread. In practice, pure arbitrage opportunities vanish in milliseconds due to competition and real-world frictions like fees, slippage, and execution risk, and which can eat into your profits quickly. Statistical arbitrage, StatArb, extends the idea by modeling long-term relationships between assets that are expected to revert to historical norms. Arbitrage illustrates a core principle of markets. Prices tend towards efficiency, and StatArb is one of the foundational strategies in quantitative hedge funds. Backtesting is the process of simulating how a trading strategy would have performed using historical data. Three simple strategies are compared: buy and hold, daily momentum, and mean reversion. And even with the same data, their equity curves diverge dramatically. The chapter also highlights the key pitfalls of look-ahead bias, accidentally using information that wouldn't have been available at decision time, which makes a strategy look far better than it really is. Backtesting is how a quant-minded investor or researcher stress tests ideas before risking real capital. It is the bridge between a strategy hypothesis and a deployable investment rule. Sharpe ties together reward and risk into a single number. How much return did you earn for each unit of volatility you endured? Above that, you could have earned risk-free. Applied to SPY, IEF, GLD, and Bitcoin in 2025, Sharpe reveals that gold was the most efficient asset by far, with 2.36, while Bitcoin's volatility wasn't justified by its returns, with a negative Sharpe. Crucially, Sharpe applies to full portfolios too. Two volatile assets combined can produce a higher Sharpe than either alone. The Sharpe ratio is arguably the single most widely used performance metric in quantitative finance, because it forces an honest accounting of both sides of the risk-reward trade-off. The first iteration of our quant dashboard focused on ingesting historical price data from the S&P 500 via Yahoo Finance and exposing a single core metric, total return. This answers a basic but important question: what performed and what didn't, over a given period. It also introduced the underlying infrastructure, a Python-based stack with a database, which turns raw price data into something queryable and reusable. For this update, the goal was to move from a single market tracker to a broader asset universe. The dashboard now supports ETFs, cryptocurrencies, and indexes, in addition to equities. As long as the asset is available through Yahoo Finance, it can be added in a structured and consistent way. This effectively expands the observable universe, aligning the tool more closely with the range of markets discussed earlier in the series. The second and more significant update is the expansion of performance metrics. In addition to total return, the dashboard now includes alpha, volatility, downside volatility, Sharpe ratio, and maximum drawdown. These metrics correspond directly to the concepts covered through the season. Alpha introduces relative performance against the benchmark. Volatility and downside volatility quantify different dimensions of risk. Maximum drawdown captures realized losses over time. And the Sharpe ratio combines return and risk into a single efficiency measure. With this in place, the dashboard moves beyond a simple performance tracking into risk-adjusted analysis. With the addition of filtering and search, the dashboard can now be used as a basic screening tool. Assets can be evaluated not just by return, but by risk-adjusted metrics and relative performance. This allows for simple comparisons, portfolio exploration, and the identification of assets that meet a specific quantitative criteria. This first season covered foundational quantitative concepts, the kind that more advanced topics build on. Future seasons are still open, but the direction is towards more complex strategies, deeper analysis, and eventually full strategy development and backtesting. There is still a significant amount of groundwork to cover, as finance is a broad and layered field. Thanks for watching, and I hope to see you in the next season. In the meantime, consider subscribing to Quant Matters here or on Patreon.